Dear investor, in this video, let's look at inflation, bond yields, earnings, valuations, and the investing themes. These are top of the mind issues that are impacting the market just now, amongst other things. High inflation is increasingly seen as being embedded in the Western world, where the unemployment levels are low. Central banks are responding to inflation like never before. Actions of the US Fed and inflation in one's own country is forcing countries to increase interest rate and tighten liquidity, while China and Japan have been some exception to this. Higher the bond yields, higher is the cost of capital, lower is the value of discounted cash flow and the value of the firm. So as yields have been increasing, markets have taken a tumble across the world. With inflation and interest rates being in focus, let us understand now, what is already discounted in the market price and how are the market poised, because, the rate increases, the regulated rate increases will continue through financial 23. Now, on the bond yields, we do expect global and Indian regulated rates to increase going forward as central banks tighten policy. However, we do expect Indian regulated rates to rise by less than the increase in the US rates. Our economy is not at full employment, and while overall the economy is doing well, a significant part is not, and growth is needed to support that part. As per current expectations, by the end of financial 23, the tightening cycle should end with Fed rates around 4% and our domestic repo rates at around 6%. 4%, US Fed would be higher than pre-COVID, 6%. Indian repo rates would be at about pre-COVID levels. This interestingly would make the difference in the regulated rates, Fed and our repo, at an all-time low of just around 2%. And this should be expected to happen because now the currency depreciation, the pace of currency depreciation has reduced. We have seen that over the past few years, and different inflation differential with the West has also reduced. As per current expectations, after the rate increase in financial 23, interest rates should start to drop again in the later part of financial 24. The expectation of convergence of yields to some extent should also happen because we are now grown in terms of size of the economy. We are the 6th largest economy, and our interest rates are highest versus the other 5 large economies and by a margin. This also provides some room for narrowing. Larger economy would mean that our inflation is also getting influenced by global factors, will probably rise by less than before, and hence our yields would also theoretically be more closer to what we have in the West versus earlier. A lot of the policy action by the central bank or proposed policy actions by the central banks may be already in the price of the bond yields. Unless policy action by the central bank is more than expected, I think further movement on 10-year yields could have already taken place. 10-year yields are already at pre-COVID levels, and going forward, any delta change in interest rate by the central banker should push the yields up by a smaller amount. To some extent, this is already happening. We have seen that increases in interest rate by the central bank has been making the yield curve move up by a smaller amount. And I guess as we go forward, unless there is a surprise element, the bump up in the yields should not be much. And if it proves to be right that most of the expectations are already built into the yields, then maybe the market is already discounting the rate increase pattern that we will see going forward. Inflation is a key concern, forcing the central banks to tighten. It may be showing signs of peaking out. The table below shows price of several agri and industrial commodities, and many have dropped significantly over the past period in response to events like Indonesia allowing palm oil exports, slower global growth expectations bringing down price of metals like aluminum, copper, and steel. And yes, Indian policy action such as imposing export taxes on steel, reducing duties on oil has also helped. Fuel prices, coking coal and coal have also dropped, as have oil prices, which have fallen reasonably sharply from 125, the near-term highs, to closer to 105 as we speak. But let's see if they stick or go down further. Easing of global supply chains has helped on the margin. There is hope on the oil front. OPEC could increase production. We would track the outcome of US President visit to the Middle East and European purchase of Russian oil. And yes, in the event of Russian-Ukrainian issue getting sorted, oil price could drop sharply. Lower inflation could change the central bank commentary and interest rate outlook. One has to remember that one manner of repairing government balance sheets is higher nominal GDP growth. Inflation is a component of that. Runaway inflation is something which cannot be tolerated, but some amount of inflation is something which is desirable in the current scheme of things. And hence, once I think the central banks get a sense that inflation is getting under control, once again, the commentary, the focus could change towards growth and inflation rather than only inflation control. Coming down to economic growth for our country, our economy has had a K-shaped recovery. This is something that we have been noticing for some time now. While overall economy is doing very well, GST numbers point to that. The high contact services part is still recovering. Our economy is not at full employment like the West, and relatively more growth-oriented policy is needed, and we believe we will continue to see. It would be good to remember, though, that longer period of stress would impact economy like India as well. We started the period in a very strong, from a very strong position, but however, as the stress period has expanded itself, we have seen forex reserves drop. INR has depreciated a bit, though lower than other currencies. Let's look at it this way: lower global growth could mean higher trade deficit, further stress on our current account. It could result in some earnings impairment as well in export-oriented businesses, for example, and in IT. Steps like export taxes on steel reduces steel prices and steel companies' profit. That's a large part of the profit pool in the country. Amongst other things that we need to track, the flow of FDI, which was supporting startup ecosystem, may dry up. This sustained stress is already to some extent being seen in market valuations. So the first few days of stress period, when oil spiked in response to Russia-Ukraine, we as an economy, we as a market were very strong. We were not perturbed, but now as it has continued, there is some amount of stress that is being seen. Oil being the main issue. I think if it comes down, things will look up. As yet, growth momentum continues to be strong. All indicators such as e-way bill, traffic on roads, power demand, etc., pointing to robust growth. Capex as a percentage of GDP is now at a 30-month high. Government capex, corporate capex, and individual capex are all increasing, providing a further visibility to sustained growth. Farm incomes are expected to be buoyant on better farm produce. Farm product prices, while volumes have taken a hit on account of excessive heat, next crop profitability should also be good because the government has protected the farmers from input price increases. while the agri product prices still continue to be high. Higher farm incomes should support the economy of the hinterland, improving the confidence of consumer businesses, the consumption part of the economy. Coming down to earnings, we have noted in one of our previous editions, our earnings could be boxed into 4 buckets. Commodities, mostly refining and steel. We have very little of oil. Banking and financials, IT services, and everything else. Let's call it others. Drop in commodity prices results in better profits in users of commodities that come in the others pack. So in some sense, there is a degree of counterbalancing that happens. If we look at banking and financials, the stress period for the economy is actually great business for them. They lend, they are lenders, they get more opportunity. Increase in interest rates means better margins for them. So yes, except for one period hit on account of higher bond yields, banking and financial space, the outlook has improved. Now, IT sector, that's the 4th bucket, on the margin may get impacted on account of lower demand that may take place in financial 24. Financial 23 seems to be all fine. But then some amount of currency depreciation that we have seen, I believe today would more than compensate for any profit hit on account of demand reduction. So I think there is a great chance that over financial 22 to financial 24, the great momentum of earnings should continue from a 720 kind of level of earnings in financial 22. We should end financial 24 between, let's say, 950 and 1025 earnings on the Nifty, giving us a nice clip of growth going forward. The fact that Nifty margins have been showing an increase over the past period from a low should help, while in the immediate term, margins may take a knock on account of higher commodity prices. Maybe towards the end of financial 23, the second half of financial 23, they will get restored in financial 24 over 23 could look as we are projecting. Coming down to valuation, this is where it gets interesting. Valuations have now corrected and are now significantly lower than the 5-year average levels. And 5-year was our favorite period for looking at valuation. They're now lower than that. And 10-year level and approaching 15-year average levels. This clearly makes the large cap index undervalued, especially if one considers the fact that index composition has changed over this period and index P actually should sustain at higher levels versus earlier. This clearly points to index offering better long period compounding possibilities going forward. The only caveat I would use is that the earnings should not get damaged materially. Otherwise, this is from current levels. Investors should expect overall better compounding going forward. And like we noted before, earnings should prove resilient unless the period of stress really elongates. In some manner, large cap valuations do discount the possibility of Western world recession to some extent. Mid caps continue to trade more expensive than large caps on a 1-year forward valuation. Okay, however, while they can correct more, and this is something we must remember, the fact that most of the themes that we would be talking of in the next section that investors are positive of today are largely represented in the mid-cap space only. And the period of growth going forward, the stronger period of growth going forward should sustain valuations in the mid-cap space also. So we're not overly negative that space, while today Optically, the valuations look higher. If one looks at 2-year forward valuations, I think even mid caps will look fairly valued and maybe lower than where they should be. Uh, Investing themes happily continue to be the same. Themes like defense, higher allocation there, and indigenization, chemicals and textiles on China plus one, PLI beneficiaries of move away from unorganized to organized are all same. They are continuing. Most of them, many of them are present in the mid-cap space. These themes should provide a tailwind for sustained long period above economic growth rates in these spaces. In the large cap space, financials are a big space to focus on. We noted the improvement in the outlook there. In the high quality space, there are spaces, yes, which are seeing some increased competition, such as paints. We have 2 new entrants there, such as cement. We have an aggressive new entrant there. And diagnostic, once again, we are seeing one new credible new competition there. We need to watch these to see how margins and hence return ratios sustain going forward. But with the above exceptions, I think the themes that were there before the market crack have endured, and this helps. Businesses and spaces that did well before the crack should come back. Hence, once the selling pressures from FPI subside, and if you look at our portfolio, this is what is helping us maintain portfolio consistency over this period. Lastly, coming down to flows, while inflation and monetary tightening is impacting everyone, surprisingly, FPIs are not sellers everywhere. This is something which is impacting everyone. So theoretically, every market should be seeing the consistent selling that we have been seeing, but that's not the case. There seems to be buyers in several markets such as Brazil, Indonesia, Thailand, and Malaysia, at least intermittently over last 8 months. And in many countries, actually the selling has been intermittent. Otherwise, they have seen mostly buying. Yes, larger markets like Taiwan and Korea have seen selling. Some of these markets may be suffering from some geopolitical heightened risk on, let's say, China, Taiwan, and that may be impacting some markets. But otherwise, the markets which are getting helped just now maybe the surplus on commodity markets. The other point that comes to the mind is one reason for us seeing the selling, apart from the fact that we are importers of oil and we get hurt when oil prices move up, is probably relative valuations. Our currency has depreciated lower, our markets have fallen lesser, and relative valuation versus the other emerging markets have increased. And there may be just about some amount of rebalancing that based selling that we are seeing. Few things can change. If it is rebalancing kind of selling, then it has to finish in a finite period of time. Now that it has taken place for over 8 months now, and 2, if the selling was in preference to oil exporting, commodity exporting countries, I think as commodity prices start to decline, this thing can change in our favor. We have noted before that over the last month, commodity prices have broadly declined. Domestic flows are enduring quite well, in spite of the volatility, in spite of the fact that markets have now taken away 1 year full of gains. What has happened is equity allocation was already low. It's gotten lower with the market fall, and sustained inflows need to be there to correct the imbalance and grow it over a period of time. While, of course, competing investment avenues have cropped up. Interest rate increases make some other parts more interesting. But I do believe domestic flows into equity would prove to be more structurally positive than, let's say, FPI negative flows that we have been experiencing. To sum up, overall, I believe the valuations are now in the cheap zone. which large cap part of the market and market indices having a good chance of stabilizing at current levels, especially if, like we noted before, bond yields do not respond significantly on rate increases that will take place in response to inflation. Any sign of inflation cooling off would be taken as positive. Any sustenance in oil decline would be taken as a positive. Investing themes remain the same, and we do believe same spaces would get the favor of growth-oriented investors once things settle down, and the same spaces would bounce back, maybe with an exception of spaces where the competitive intensity has increased. We clearly expect the high quality, high growth space to be less volatile going forward, especially as commodities are falling and maybe be the first to bounce back. We are already seeing it in financials. We should start to see it in a broader part of the market as we go forward. With that, thank you for listening in, and happy investing.